hold and forget investment strategy really as foolproof as it sounds? Let's dive deep into this strategy and explore whether this approach always leads to big returns. As of recording this video, the Nikkei 2225 index, which is the Tokyo's stock market index, is at a staggering 31,000 level. That's an impressive 21% increase in the past year, soaring from almost 26,000 levels. But here's a fascinating fact for you. The Nikkei had reached this peak twice before. Once in 2020, just 2 years ago, and another time way back in May 1991. Now, why is this significant? Well, it's worth considering that if you had invested and held onto your investment in this index from May 1991 to December 2022, you would have seen no real gains. In fact, when accounting for inflation, which ranged from negative figures in the 90s to roughly 1 to 3% in the 2000s, you would have effectively lost some money. So does this mean hold and forget strategy is inherently flawed? Not at all. But here are 3 crucial factors for you to consider. Number 1, industry growth. Take time to understand whether the industry in which your company is operating is experiencing growth or is it stagnating. For instance, consider industries like the mining industry, coal, iron ore, oil and gas. All of these industries are declining because people are moving away from the traditional sources of energy to more cleaner sources of energy. The other industry would be the traditional automotive sector. Again, people are opting for more electric vehicles or hybrid vehicles, and even the traditional soft drinking industry. People are moving away from that as people are becoming more health conscious. Number 2, company outlook. Keep a watchful eye on the company itself. Are the sales dwindling? Are profits really declining or stagnating? Is the market share really slipping away? These are some red flags that you should not ignore. Number 3, whether the stock is overvalued. Assess whether the company's current price to earnings ratio, the PE ratio, is sustainable in future. For example, let's look at Nvidia. I know there's a lot of hype around Nvidia, and that's why I picked up Nvidia as an example. It is trading at a whopping PE of 105. However, its competitors are somewhere hovering between 15 to 24. So do you think Nvidia would be able to sustain this high PE forever? The short answer is no. If you look at the historical PE, then it has fluctuated quite a bit, but it averages roughly around that 50 mark. But wait a minute. Isn't the industry as a whole growing, and so the pie in itself is becoming bigger and bigger? Well, yes, the gaming industry, the computer gaming industry is poised to grow roughly at around 8 to 10% each year, at least in the next decade. So wouldn't Nvidia profit from that? It would. However, there are many competitors who would also benefit from this. If you look at companies like Intel and AMD, they have heavily invested in their R&D, and they are introducing some very powerful chips, and they are going to launch that in the very near future. So are you saying that will impact Nvidia's share price? Probably. The room for growth for companies with a relatively lower market share is much higher in comparison to companies which have already grown in size. Think about it, whether selling when you've already seen significant gains might be more rewarding than holding it indefinitely. So you might now wonder if investing in stocks is really that easy and I should just invest in index funds, right? So if you believe that indices are inherently designed to go up, then hear the story, okay? It is generally true, but again, not all indices are the same. I gave you an example of the Japanese stock index in the beginning of this video. I'm going to give you another example, which is the ASX 500. This is the Australian stock market index that tracks the top 500 companies in Australia. In 2007, it was riding high at 6,700 just before the global financial crisis struck. It took a whole 12 years for it to reclaim that level. But if you would have invested somewhere in the early 2009, when it had reached the low of like 3,500 levels, you would have doubled your investment by 2020. which is nearly 8 to 9% returns year on year. Now that's not bad, right? But what does it mean? It just means that while time in the market is important, timing the market is equally important, especially before a major correction, before a recession, or even any global political event that might impact economies across the world. The more prudent strategy in such times is not to invest in any index fund in bulk, but to buy more as the index falls downward. That's called downward averaging. But you might say that, hey, I'm not investing in Australia or in Japan. I'm only investing in safe markets like US or India. Well, the Japanese investors in 1991 were just like you are today. They didn't know that their country was headed into a 20-year-long recession, right? I'm not saying that we are headed into a recession or US is headed into recession, but there is always that country risk that you must consider before investing your money for long term. And when I say long term, I mean 10, 20, 30 years. In conclusion, the hold and forget strategy it's not inherently flawed, but it's not one size fits all. Industry growth, company outlook, valuation, these factors should guide your investment decisions. Even in index investing, timing matters. And don't forget about the country specific risks. Remember, investing is a dynamic journey, and staying informed and adaptable can be the keys to your financial success.